Hey everyone. Camera's on. A million questions I see here. All right, make sure you have your cameras on. I see Nidia. See Jacqueline not there. Benjamin not there. Brittany, Nina, Arlene, I see you. Elda, I see your hand freezing. Alondra. I see Olga. Okay, Yanita and Amy. Cameras are not on. All right, so let's start by addressing the questions that were presented by Nina, which is everybody's questions. I know you guys submit to her over the weekend. I'm sorry, we're gonna have a little background noise over here. All right, cool. So here are a few questions from Nina before we start. And can you explain PMI and MIP again? All right, so both PMI and MIP serve the same purpose. It's an insurance to protect the lender in case you, the borrower, defaults. All right. The only difference between PMI and MIP is that PMI is used for conventional loans, and that's why it's called private mortgage insurance. It's a private company that insures the bank. MIP, it's a mortgage insurance premium that you're paying for FHA, the Federal Housing Administration, to insure the bank. So it's whether it's private or it's government insurance. PMI, private insurance, because you're dealing directly with the bank. It's a conventional loan, so it's between you and the lender. MIP is a premium you pay for FHA to insure the lender because it's FHA type of loan. So there's three parties involved: the government, the bank, and you. So that's why I need to have that MIP insurance. Okay. The beneficiary of the insurance, yes, it's always the bank, because again, these insurances are created to protect the lender in case the borrower defaults. So yeah, the beneficiary of the policy is the lender. Great question, not tested, but it could be an attorney, it could be a title company, it could be a bank's escrow department, or a totally separate company that they use for management, right? So management of their loans. Okay. Is the mortgage repayment also factored into the sales price of the sales property? The due on sale clause. So mortgage repayment is based on a principal. Okay, always think about that. This mortgage repayment right here is based on principal. So that's the interest that you're going to pay is not factored into the sales price. What's factored into the sales price is the amount that you're borrowing. That goes into the sales price plus. So it's sales price minus commission minus closing costs, and then the balance will be the whatever the seller takes home, right? But on the buyer side, there's the purchase price minus down payment is the loan amount. So for the buyer side, it's as simple as that. When you look at mortgage repayment, it's just whatever is the balance on the loan. Now, why do we have the balance on the loan? Because whatever you purchase for is to cover what we said before, the seller's expenses. So it will pay for whatever the seller has to pay in commission, whatever the seller has to pay in closing costs, and whatever goes back to the seller after paying, let's say, a mortgage that's due. So there's two sides to this: the seller side and the buyer side. Mortgage repayment on the buyer side is the loan amount. Mortgage repayment on the seller side is the balance of the principal due on that mortgage, the original mortgage loan. Okay. Are conventional loans only given by private? No. So conventional loans, let's say you need a loan, you go to Bank of America. And you're getting a loan with Bank of America that is not sponsored or has any type of government participation. That is a conventional loan. So a conventional loan is a traditional loan between the bank or lender directly and you, the borrower, directly. So again, there's no third party like a FHA or VA to participate in this transaction. So conventional loan strictly means traditional loan. It's you go to the bank, you ask for money, bank says, hey, according to our guidelines, this is what you're approved for. That's it. In an FHA loan or a VA loan, they have to check FHA and VA guidelines before they give you the loan. That's the only difference. Conventionals, strictly between you and the lender. So it's not private lenders, it's you and the lender. Could it be a private lender? That'll be a conventional loan. Could be an institutional lender like Bank of America, Wells Fargo, Chase, and so on. It's still a conventional loan. It's just the fact that it's two parties, the borrower and the lender, makes it a conventional loan. And I think I just answered this. The lender's not always the bank. The lender's whoever lends. So I can lend you money. I could be deemed a lender or a creditor. Okay, but that again, that depends on how many times I lend. After 5 times lending, I become a creditor and therefore considered a lender or creditor. Can I repeat the third party again? Oh, for the trustee for the title theory. Like I said, it could be an escrow company, like a title company. It could be an attorney. It could be like a property management company that the bank or style like the bank hires to handle all these titles. So third party could be anybody that the bank appoints as their trustee. So if we open up a real estate trust right now, all of us, we're going to appoint somebody. Does it have to be somebody specific? No, I feel like appointing you, Nina. You'll be the trustee, right? I feel like appointing the attorney that helps us. The attorney will be the trustee. So that third party in a title theory state, so one that uses deed of trust, the third party could be whoever the bank determines to hold the title, separately. Hey, if borrower defaults in paying me, you enforce this document and go to auction. So anybody that we appoint as a lender will be the trustee, the third party. Okay. And again, the beneficiary is me. I lend it to you. So again, what am I doing? So addressing this one right here. You borrowed from me. I'm your lender. Whether it's me as an individual or me as a corporation, I'm your lender because I lend to you, right? You're the borrower. And we place the title with a third party. So who's the beneficiary of that trust? This is the trustee. You are the trustor because you're the one that created, where you pay me. Trustee holds the title. But I'm the beneficiary of that trust. If you don't pay me, the trustee will enforce, so I recover my money. So the trustee takes it to auction. Instead of a lien theory state where there's a mortgage and there's a sheriff that will auction the property, this is we already appointing somebody saying, if you don't pay me, I'll have the trustee enforce the sale of this property so I can recover my money. So whatever comes from that sale is for me, the lender. So the lender is the beneficiary. Whether it's the bank or a private lender, that's the beneficiary of this title theory type of loan. And I know when Nina disappears, I'm telling you, ninja. She disappears off the screen, she's typing. So it's what I just said. The lender, whoever lends, is the beneficiary. So whether it's the bank or it's me. If I'm the one lending to you, then I'm technically the bank. I'm the lender. So if I created it in this scenario where there's a third party, the trustee, I'm the beneficiary, you're the one that created the trust, you're the trustor. You're the borrower, the trustor. I'm the lender, right? And the trustee is a third party holding the title. So again, whether it's me as an individual or it's an institutional lender like Bank of America, Wells Fargo, so on, we are always the beneficiary because we're the ones waiting for that payment to come in. And if you default, who benefits from this transaction? Well, I do, and I'm going to ask the trustee, the third party, to sell so I can recover my monies. The beneficiary could be the bank, could be a private party, but we call this the lender, which the lender could be, again, the bank or a private party. Good? All right. If anybody's watching on YouTube, let me know you're there so I can address your questions as we go. All right. Anybody else has any questions before we start? No questions? You can submit them to Nina, my class assistant, and she will post it for you. Nidia just laughs. Nidia, you're going to miss these classes, I'm telling you. All right. So if there's no other questions, we're going to move forward. And today, we're going to do part 3 and part 4 of real estate finance. So we are on chapter 17 from this book, right? And if you had the Dearborn version, we would be on chapter 15. That's where we start talking about primary, secondary markets. We talk about truth in lending, Regulation Z, and so on. Okay. All right, so we did talk about truth in lending and Regulation Z briefly in the previous chapter. Now we're going to go in detail. So truth in lending and Regulation Z. And we're going to repeat all this in a few chapters. Ready? I need your full attention because this week is going to be a little tough week. It's been easy so far. So now we're going to get a little tougher. All right, so I need your full attention. So the Consumer Credit Protection Act, which was enacted in 1969 and since amended in by the Truth in Lending Simplification and Reform Act, is implemented by the Federal Reserve's Regulation Z. Remember this, Regulation Z. Okay? Regulation Z. Hold on. Is the weather going to affect the streaming of the class? What do you mean? A little bit of rain? It affected me getting here, but it didn't. I don't think it's going to affect the streaming. That depends on your internet or my internet. So could it affect? We have very strong internet here, so hopefully on our end it doesn't. And your end I can't control. Not that I can control here either, but it should be good. The sound is going in and out and I'm freezing. It is a little bit chilly in here. I already turned up the heat. But as far as the sound going in and out, is everybody having a problem with this, or you guys can hear me? Let me know, all of you. Let me know if there's anything going on with the sound. Let me know in the chat. Does it sound okay for you, or do you hear me in and out? Let me know in the chat, please. This also lets me know that you guys are there. Alondra says not now, but a minute ago it was going in and out. Benjamin says okay. Elda says sometimes. I hear it for the most part. I hope so. All right, cool. So whether I listen, I don't know. I'm gonna do the best I can. I hopefully won't stop at any time. But if it does, we'll have to. I'll just repeat whatever I need to repeat. Today's just part 3 and 4, so we should finish a little bit earlier. Again, if I have to repeat, I'll repeat. You guys just let me know, stop, Bruno, I did not understand, and I'll explain again whatever I just said. All right? I'll hit replay on my end, and then you guys just hear me again. Is that a deal? Thumbs up? Great. All right, so let's go back to this. Regulation Z. So remember Regulation Z because it's very important. That goes with the Truth in Lending Act and applies to loans secured by a residence. So Regulation Z applies only to residential property, not commercial. Okay, Regulation Z, take a note, applies only to residential property. It does not apply to commercial. So when you see Regulation Z or Truth in Lending, it applies to residential transactions, does not apply to commercial transactions. Now, one of the things implemented by Regulation Z is the disclosures of costs. You guys think you should borrow money without knowing how much that money is going to cost you? Should you borrow money? Of course not. So in order to protect the consumer, Regulation Z was created or implemented where the lender must disclose all finance charges, as well as the true APR, which is annual percentage rate in advance of closing. What does that mean? It means that before you move forward with a transaction, you must be well informed about the total costs of this loan. I'm borrowing $100,000. How much am I going to pay for the $100,000? Well, if you borrow for the whole 30 years, you're going to pay $160,000 in total, as an example. So you borrowed $100,000 and you pay $60,000 in interest and charges and all that stuff. You have to know this up front. This is what Regulation Z came to implement. Another thing that was created under Regulation Z is the right of rescission. Now, rescission means cancellation. Rescission is cancellation. So to rescind or to give up something is you're canceling this deal. So rescission is cancellation. Now, when can you cancel the loan? Within 3, it's actually business days, but within 3 days of completion of the transaction. Now, this right of rescission, the right of rescission does not apply to residential mortgage transactions. Okay, so what we're saying is that the mortgage loans used to finance the purchase do not apply. So if you're buying a house right now, can you cancel the loan? Until closing, you can. You can switch from one lender to another until closing. You can change the terms of the loan until closing. But from the day of closing on, all right, let me pause for a second. If you guys are distracted, this will not be easy. Letting you know right now, again, if you guys are distracted, this will not be easy. I see some people on the phone, some people talking. I'm just giving you a heads up. It will not be easy. From here on, it will not be easy at all if you are distracted. And watching replays is not the same as being part of it. Okay? So make sure you're paying attention, no distractions, please. It's for you, it's not for me. All right? I already got licensed. As a realtor, as a salesperson, I'm licensed as an instructor. I have a school and I have a real estate agency. So it's not for me. If you guys are not paying attention and you fail the exam, I'm sorry. I am giving you my all. I expect you to do it for yourselves as well. All right? Thumbs up? We're going to do this or... Okay. Eliminate distractions, please. So, back to this. What I was saying is, for you to cancel a loan, it has to be in a purchase. At the time of purchase, it has to be until closing date. You can switch loans until the day of the closing. After you entered into a loan for the purchase of real estate, you no longer have a right of rescission. That loan is valid for the next 10 years, 15 years, 30 years, whatever you guys agree to, or until you prepay the loan. Okay? So this rescission period applies to refinances. So let's say you purchased a house and 6 months from now, you decide to refinance or restructure the loan. You go to another lender and say, hey, I have this house, it's worth this much, I'm paying this much of interest, I want to see if I can drop the interest, right? There'll be a new loan, it'll be a refinance. They'll give you the loan. The moment you close on that new loan, can you cancel the transaction? Can you revert everything and go back to the loan you had? Yes, you can, within 3 business days. If it's a refinance, not a purchase, it does not apply to purchase of residential properties. It applies to refinances. Okay? Take a note on that, please. It does not apply to the purchase of residential property. It applies for refinancing. You can refinance and, you know what? I don't like the loan. Revert. Go back. You can. For the purchase, you cannot. Okay. Next. Advertisements. Now, you're probably thinking, well, advertisements, I don't do mortgages. Why do we need to know about advertisement in mortgages? Well, mainly because you might participate in some way, somehow, in the advertisement of a mortgage. For instance, and this is before I show you this, but let's say you prepare a flyer, and in that flyer you have a house and all the information about the house, okay, around it. Here at the bottom, you're going to have 2 business cards or business information. You're going to have the agent, which is you, and here you're going to have the mortgage rep, right? Because here's the thing. If you do things right, obviously with the knowledge of your broker, because the broker needs to approve, but if you do things right, you're going to have mortgage people, title people, all these attorneys. Everybody's going to help you up to 50% of the costs of your marketing, right? Everybody's going to help you with that. More than that, it's illegal, but mortgage people, they can cover up to 50% of your costs. So if it costs you $100 to print flyers, 50 on you, 50 on them, it's fine. Usually, why would they give you the money? So they give you the money with a condition, and usually that condition is, hey, whatever marketing you do, you have to include my info. If it's something that we're doing together, you must include my info. I'm not going to pay for you to put somebody else's info there. It only makes sense, right? But if it says somewhere in the marketing says pay only $1,400 a month for this house. Okay, so this is the house that you're advertising, a 2-family, 3-bedroom, 1 bath in each unit, right? Pay only $1,400 a month for this house. My question for you guys is very simple. Do we all qualify in the same way? No. Do we have the same credit? No. Do we have the same income? No. No, no, and no. So we are all different. The same way we have our own fingerprint, we also have our own financial fingerprint. Everybody's different. Look, you can make $100,000 a year. I can make $100,000 a year. You can have a 780 score. I can have a 780 score. Right? But everything else is different. I can have $30,000 in the bank account. You can have $30,000 in the bank account. But the way I do my taxes, whether I have dependents or I don't have dependents, whether I do jointly or I do single, there's a lot of variables that come with it that makes this questionable. Can I tell you you're going to pay $1,400 for this house? Right? I can tell you after you were pre-approved, and those are the final numbers for you, right? But I cannot advertise for the general public unless I put certain disclosures. So here I'm going to have to put a little asterisk, right? And some type of disclosure somewhere, really tiny letters, somewhere at least, right? Saying to a qualified buyer or based on $100,000 a year, right? And 780 score. Like, I have to give more info. I also have to give you I cannot give you just 1,400. I have to say that this is based on a 5.14 APR. So I got to give you a full disclosure of how I came to this number. You understand? And if you don't have this income, if you don't have this credit, then you might not qualify for $1,400 a month. Okay? So it says here that advertising, any type of advertising to offer credit is subject to requirements of full disclosure if it includes down payment percentage, installment payment amount, specific amount of finance charge, specific number of payments, specific repayment period, or even a statement that there's no charge for credit. So all of these are specific terms, specific numbers. Therefore, more disclosure must be included. So full disclosure must be included. All right, so remember, as long as it's something specific, as you can tell here, disclosures are required. Me saying, for instance, financing available. Does that tell you anything? Like specific? No, financing available. So if you want to buy a house, there's financing available. How much will your payment be? What will be the interest? We have no idea. But financing is available, right? Taking over a loan is available. Does it mean you're going to have the same terms? Not always, right? So being broad, being liberal in the terms or generic terms, no problem. Once it becomes specific, that's where the problem is. Okay? So if any of these items appear in the advertisement, the lender must include the down payment amount or percentage, repayment terms, the APR, and whether the rate can be increased after consummation of the rate. So if any of these specific terms are included, I must give full information of how I came to that number. That's all. Okay? Non-compliance. If you do not comply with Regulation Z, don't worry, it's not that bad. You could go to jail for up to a year. That's it. You get free rent for a year. And you can pay fines of up to $5,000. It does not say here, but it's per day. So it's $5,000 per day that the violation continues, right? And there might be other damages added to it as well. Anyway, so it's not that bad. Don't worry about the marketing. Go ahead and just put whatever you want. Nobody's going to come after you, right? So just be very careful. All right, RESPA. This is another one to remember. So we have Regulation Z, which is Truth in Lending Act. And now we have RESPA. Now, RESPA is a federal law which aims to standardize settlement practices and ensure that buyers understand settlement costs. What is a settlement cost? closing costs. Right? How much does it cost to settle this transaction? That means how much does it cost to close on this transaction? Shouldn't you be aware of everything you're going to have to pay before you go to the closing table? Right? That's what this law is about, is you knowing the true cost of that closing. So Regulation Z is knowing the true cost of lending. So how much is the loan going to cost you? RESPA is knowing the closing costs, the total closing costs. Now, again, just like Regulation Z, RESPA applies to purchases of residential property. So RESPA applies to purchases of residential, just like Regulation Z, right, applies only to purchases of residential property. All right? We're good so far? Okay. Now, under under RESPA, there's different sections of RESPA, right? So there's RESPA is an act and has different sections explaining what the act is. Now, in addition to imposing settlement procedures, which is what you should do towards the closing, right? RESPA also provisions also prohibit lenders from paying kickbacks. What does that mean? I cannot send a borrower to a lender and get paid money for referring. All right? So if I do, then I must be licensed and I must have taken some type of action. That's why it says unearned fees. If I did not earn them, meaning I did not participate in that side of the transaction, can I collect money? No. So it's pretty much like us guys in real estate world. As a salesperson, can you refer business? Yes. Can somebody non-licensed refer business to you? No. I mean, they can as long as they don't expect to get paid. So no kickbacks. You got it? So if your cousin wants to refer a client to you, can your cousin get paid? If they're licensed, yes. That means they earned fees. They are licensed to do so. If they're not licensed, then no. They can refer, but they don't get paid. And pretty much that's what RESPA says as well. If you are not licensed and not participating in the transaction as a lender, a loan officer, or something like that, right, then you cannot collect any monies. Okay? To assist in informing and educating the borrowers, RESPA requires that lenders provide a loan application with a loan information booklet, which is your home loan toolkit, and a loan estimate. The booklet produced by the Consumer Financial Bureau explains RESPA provisions, general settlement costs, and the required closing disclosure form. The lender must provide, we're going to go over all this several times, but the lender must provide an estimate of closing costs within 3 days following the borrower's application. Okay, assume always 3 business days, calendar days. Okay, I'm sorry, business days, not calendar days. I will tell you when it's calendar, when it's business. In this case, business days. Now, Consumer Financial Protection Bureau, CFPB, requires lenders to use 2 specific forms to disclose settlement costs to the buyer. A lender must provide loan estimates or LE, loan estimates or LE, within 3, this again, it's business days, within 3 business days of receiving the loan application. So the LE or the loan estimate, take a note somewhere, the LE or loan estimate, every time you see LE is loan estimate, must be given to every borrower within 3 business days, within 3 business days, not bedrooms, 3 business days, this is business days, of a complete loan application. 3 business days of a complete loan application. So the loan estimate must be provided within 3 business days of loan application. Also, they must provide to the borrower a closing disclosure, or CD, within 3 business days before the closing. So, I apply for a loan. You have to give me a complete loan estimate after a complete application. So the loan estimate after a complete application. I applied for a loan. Show me the LE, which is, as it says, it's a loan estimate. It gives you an estimated idea of how much the loan is going to cost you, right? As far as the CD, it's the closing disclosure, and as it says, it's closing. So if it's closing, before closing, I'm entitled to know what are my final numbers. So at least 3 business days before closing, that's when you sign the final terms of the loan. At least 3 business days before closing, I must get the closing disclosure. Okay? So 3 business days, 3 business days. One is 3 business days of application. The other one's 3 business days before closing. As I said already, a lender must provide a buyer with a copy of the information booklet, Your Home Loan Toolkit. Right? So the Home Loan Toolkit gives you all the information about the potential loan, about the potential closing costs, closing procedures. So it's a nice booklet to have and present to your buyers. Now, what I recommend, guys, eliminate distractions, please. Kick everybody out of your rooms. Stay with me. Thank you. So, before even applying for a loan, before talking to anybody about mortgages, if a client wants to buy a house and they expect to finance the purchase, grab the booklet, sit down with them, and go over the booklet. It's not your responsibility, but if nobody else does it, you're just eliminating potential failures along the way. So you're just saying, hey, listen, this is the credit score, how it works. This is discount points versus the actual loan interest. This is the down payment, the loan balance. These are the mechanics of this loan. So just like we went over on Friday, and we're going over now, all that will be provided in that booklet. So like a summary of everything, okay? It's called Your Home Loan Toolkit. Every single realtor should have it, review it, and understand it, okay? Your Home Loan Toolkit. So other disclosures that must be provided is the settlement charges, title charges, recording. This is all from the settlement. Closing costs. All this should be given to you up front. Recording and transfer fees, reserve deposits required, tax and insurance escrow. By the way, every time you see tax and insurance is escrow. Every time you see escrow is tax and insurance. So you might have a question in the state exam that says the impound fee or the escrow fee. What is it called? Or what is it about? Tax and insurance. Okay. Nina says, what were you saying after closing disclosure? I was talking about the home loan toolkit, where I said that it's a booklet that summarizes the whole transaction, and that you should review this with your clients. So every realtor should have this, because it talks about everything we talked on Friday and we're talking about today. So about discount points, about the APR, why you should shop for different lenders, right, versus just sticking to that one, and so on. All right. Anyway, the closing disclosures with RESPA will be all these. Everybody should be aware. Now, federal law, and this is, I think everybody knows this, Federal law requires that borrowers seeking financing for a property that's located in a flood zone also obtain flood insurance. Okay, so it's required. Federal law requires flood insurance. Okay, so if the property is in the flood zone, obviously flood insurance. Any questions before I move forward? Questions? All right. So here's what we got next. The mortgage market. What is a market? Who can tell me what a market is? Let me know in the chat. What is a market? Write it down. What is a market? Come on, children. Participate. What is a market? Don't just hold on to your coffee mug or talk to your neighbor. Write down. What is a market? Nydia, Jacqueline, Elda. Let me know what's a market. Arlene, what is a market? Come on. Benjamin says it's a place to buy and sell. Alander says a place with a variety of services and items to purchase. Olga says price comparables. Okay. Anybody else? What is a market? We're not talking about real estate. We're talking about in general. What's the word market? What does it mean? I'm going to take points away from whoever does not answer. I'm taking points away. Elda says business. Okay. Nobody else? Buying and selling. Okay. Is it Monday morning? Is that where we're at? When you go to the market, what do you guys do? Oh boy. Browse. There you go. But what do you browse? Whatever's available, right? For sale. So yes, buying and selling. Okay, I'm going to go with these answers I have here. It's a place to sell and buy. A place with a variety of services and items for purchase. So a market is where things are bought, sold, traded, and so on, where it's available for other people to, again, to acquire or to sell. So market, that's what it is. Now my second question is, hopefully some more people will answer. My next question is, and by the way, whoever's on YouTube, you can also ask these questions and reply to these questions. If a market is a place where we buy and sell stuff or trade stuff, right? Then what is a mortgage market? What is a mortgage market? If a market is where we buy, sell, or trade something, then what is a mortgage market? What do you guys think? Lending options available, properties available, okay. What else? a place where you trade mortgage loans. Okay. Looking for the right mortgage. Okay. We'll go with that. What else? Come on, children. Participate. You're not getting a star today. I have a bunch of stickers. Look, whether you're right or wrong, participation changes everything. So whether you're right or wrong, I really don't care right now. I care about you participating because that engages you in what you're learning instead of just listening. So just put answers. Elda says property available. All right, let me ask the question in a different way. Ready? Ready? Who wants to pass this class? Raise your hand if you want to pass this class. Okay. Oh, now all of you listen. Now all of you reply. Great. So hold on to this thought. You want to pass this class? Great. Participate. Eliminate distractions. Stop going on your phone. Stop talking to other people. It's only 3.5 to 4 hours that you're going to be here with me. Okay, that's it. So for this moment that you're here with me, focus, reply, participate. Let's engage. The same way, because I could really just pre-record this class, put it here and let you guys listen. But that's not going to make you pass. Do you guys understand? It's this interactivity that we're having, right, that will help you pass. It will help you exercise your mind towards the subject. So I need your participation. Okay. Arlene, try to answer in the Zoom, not in the WhatsApp, but I appreciate that. Different lenders, okay. But don't put it on the WhatsApp, because in the WhatsApp then people get confused. Whoever's not in the class will figure out what's different lenders. What is that? But always do it in the Zoom. So what is the mortgage market? It's very simple. If a market is where things are traded, so there has to be availability, right? Then something was created and something was bought, traded, or sold later on. So there has to be a creation. So in the mortgage market is where we're going to find different lenders, right? And where some lenders buy and sell those particular mortgages. Now, why would I show up in a particular area and say, hey, I'm going to lend to you versus another area? Well, it depends on the demand. So we're going to go over supply and demand for money. There are certain areas, like here in Newark as an example, it's a hot market right now. Jersey City, New York is always a hot market, right? So there's a need for more money. Do I have money to lend to everybody? No. So one thing that happens is I'll lend to you and then I sell it to somebody else. And then I have money because I sold the loan. I have money to lend to more people, right? So the supply and demand for money will help us determine the primary and secondary market. Okay? These right here, you're going to learn later on, these are players in the secondary market. But we're going to go over this in a second. So let's start with supply and demand for money. Money is a limited commodity, right? Subject to the effects of supply and demand. The federal government monetary policy controls the supply of money in order to achieve the country's economic goals. An excessive supply of money usually causes interest rates to fall and consumer prices to rise. Conversely, an excessive demand for money, such as for mortgage loans, causes interest rates to rise and prices to fall. Regulation of the money supply addresses these fluctuations with the aim to control and limit wide swings of supply and demand cycle, which we went over the other day. These efforts, in turn, help to buffer economy from severe inflationary and recessionary trends. So who regulates this money supply? Who regulates this? Well, the Federal Reserve. Federal Reserve is the entity that regulates the money in this country. the money supply. As you know, they print money against the alleged gold that we have. So the more money they print, the less it's worth against the gold. But they control it in several different ways for the mortgage markets. They control it, the selling and repurchasing government securities, primarily treasury bills. They regulate by changing the reserve requirement for member banks. So reserve requirement is the percentage of depositors' funds that the banks and other regulated financial institutions may not lend out. For instance, you deposit, let's say $1,000, right, into your check account, right? The bank has to keep 10% of that money, and they lend 10%. So they keep and they lend. So for every $1,000 you deposit, they keep $100 in case you need the money, and they lend $900 to other people, even back to you as a credit card, as a mortgage loan, as a personal loan, whatever it might be. So how do the banks work? They keep a reserve and they lend all your money out. So they make money out of your money. The Federal Reserve also regulates the changing of the interest rate or discount rate. So the system charges member institutions for borrowing funds from the Federal Reserve central banks. So a Bank of America will borrow money from the Federal Reserve in order to lend to you. Federal Reserve charges a fee to Bank of America. It's called interest. Okay, it's a very minimal fee. It's 0.5, something like that. Right, so way less than 1%. But that's what they charge the banks for borrowing money, and then they lend to you at 2, 3, 4, 5, 6, 7, 10%, whatever they want, right? Within reason, of course. When the Federal Reserve sells treasury bills, the money paid for securities is removed from the economy's money supply. Conversely, when it purchases treasury bills, the cash paid out to investors puts money back into the economy. The second type of control, which is regulating the reserve requirements, effectively restricts how much money the banks can put into the economy. Like I said, they keep 10% or 5%, whatever the requirement is from the Federal Reserve. This way, they don't lend out all the money, right? So when the Federal Reserve raises the reserve requirements, banks have less money to lend, decreasing the money supply. When the Fed lowers the reserve requirement, the banks have more money to lend, increasing the money supply. The third control, and perhaps the most effective, is the regulation of the discount rate. Like I said, how much they can charge, borrow the money at. Okay, so again, if that discount rate is lowered, the banks have incentive to borrow more money to lend to customers. Why do they do this? Again, I don't have all the money in the world to keep on lending to you, so I need to borrow money to lend to you, right? And that's the way it operates. Federal Reserve lends money to banks, and they lend to you. Now we have two markets. We have the primary mortgage market and we have the secondary mortgage market. With that comes a question. Guys, can you tell me, and I need all of you to answer, okay? All of you to answer. What are the primary colors? What are the primary colors? I need all of you to answer. What are the primary colors? Yeah, exactly. So we're going to get stuck here until everybody answers, okay? So there's 13 people here. I need 13 to answer. What are the primary colors? Nina says red, and that's it. I'm not giving you any more, right? Alander says red, blue, and yellow. Elda says green. Vanessa, red, blue, and yellow. Nina gave me one more, yellow. Okay. What are the primary colors? Guys, make sure your cameras are on. Okay, we got blue, we have red, green. Nina just went like, I'm gonna give you an installments instead of giving the full answer. Because we're talking about mortgage is never a straight pay. So we're gonna break it down. So then we have red, green, and blue, red, yellow, and blue, green, red, blue, and orange. Okay. Who else? Is it that difficult? You can't type it? Black and white are not primary colors, no. Oh boy. Gotcha. Okay. All right. Primary colors. Ready? They're red, blue, and yellow. That's it. Those are the primary colors. Now, what is the point with the whole primary color thing? The red, blue, and the yellow. So, white and black are not primary colors, but I understand where you guys coming from. But they're not, because for you to get black, you have to mix all the colors, and it gets darker and darker and darker, right? As far as the white, I don't know how it's not a primary, but I'm not the one that created the primary and secondary colors. The point is, we have primary colors and we have secondary colors, right? The primary colors, they do what? They originate, correct? They originate the secondary colors, because when we mix blue and yellow, what do we get? Green. When we mix red and yellow, now we're getting to the oranges, right? As an example, red and blue get to the purples and violets and all that stuff. So the point is, you need to originate first in order to have a secondary market. The primary market is where loans originate. Primary market is where the loans originate, where they're the basis of everything. So the secondary market is where loans are bought and sold after they originate. We're going to highlight that as well in a second. So remember, primary market is where it originates, is where it starts. Originates is where it starts. Okay? Where it's created, where the loan is created, where it starts. And then secondary market, after origination, is where loans are bought and sold. So for instance, I'm going to lend to you money. I'm Bank of America. I'm going to lend to you. And then I'm going to sell the loan to Chase. Well, Chase did not lend to you. Chase bought the loan from me. So Chase is in the secondary market. I'm in the primary market because I'm the one that lent to you. Right? So whoever lends is on the primary market. I'm sorry, in the primary market. And whoever buys a loan or trades a loan is operating in the secondary market. So primary market lenders, these are the entities that lend to you directly. Savings and loans associations, commercial banks, mutual savings banks, life insurance companies, mortgage bankers, credit unions, and even private lenders like me. I would lend to you. I'm in the primary market. Now, mortgage brokers, if you hear the term mortgage broker, and notice I have in green broker, mortgage brokers do not lend to customers directly, right? Because a mortgage broker, as the name says, they're brokers, right? So they're facilitators. Or they're mediators, just like us. What do we do, guys, as salespeople? What do we do? Do we help people sell or we sell? No, we help them sell. Because we don't sell a home, we don't buy a home. We just help people meet in the market, and we facilitate the transaction. We are real estate brokers, okay? So we're part of a brokerage, so we broker. We don't sell anything, we don't buy anything, we just help people accomplish their goals, right? A mortgage broker does the same thing. A mortgage broker finds a lender for that borrower, and they matchmake. That's it, okay? So a mortgage broker does not lend directly. Mortgage bankers lend. Mortgage brokers, they facilitate or mediate the transaction, right? Between a lender and a borrower. They're the in-between like we are, okay? Then we have portfolio lenders. Then we have portfolio lenders. Now, what is portfolio? What it means portfolio? Portfolio is something that I keep with me, right? So I have a portfolio of pictures. I have a portfolio of properties. I have a portfolio of computers here. Portfolio means it stays with you. It's part of your collection. Let's put it like that, okay? It's part of your collection. So a portfolio lender does not intend to sell in the secondary market. A portfolio lender originates the loan and retains the loan in their own portfolio. So I lend to you, and over the next 30 years, you're going to see me, right? So if I'm Bank of America and I'm the portfolio lender in this scenario, for the next 30 years of your loan, I'm the one collecting on that mortgage payment, okay? If I'm not a portfolio lender, like I said, I'll lend to you, and then I sell the loan to somebody else right away. So now you can start getting collections from Chase, Wells Fargo, from another entity, not the one they originated. Okay, so every time you see portfolio lenders, they keep the loan in-house for the term of the loan, whatever it might be. Okay? Next page. It says right here, lenders, investors, and government agencies, they buy loans already originated. If they do that, they are operating in the secondary markets. Okay? Loans already originated are in the secondary market. If they're buying loans in the secondary market, every time you see they buy a loan, the term buy a loan, that means they're operating in the secondary market. Okay? Who do we find in the secondary market? We have Fannie Mae. I'll go over these better later. We have Fannie Mae, we have Freddie Mac, we have Ginnie Mae. Investment firms that assemble loans into packages and sell securities based on pooled mortgages. So all of us could get together and buy a bunch of loans from a bank, right? Then we're an investment group. Life insurance companies, they do the same. Pension funds, they invest in them. And primary market institutions who also invest as secondary lenders. So like I said, in this scenario, it's Chase, Wells Fargo, Bank of America. They're in the primary market, but they might invest in the secondary market as well. And that brings us to money flow. Now, I'm going to start from the end instead of starting from the beginning. You intend to borrow money, right? For you to borrow money, you must have a lender. The lender does not have all the money in the world to keep on lending to borrowers. So they obtain money by selling to the secondary market. And who's in the secondary market? Investors. All right, so these investors, they purchase in the secondary market in order for primary lenders to have more money to lend to you. All right, so this is the easy flow. For the money to get to you, this is how it comes through. So I have a bunch of money. What I'm going to do, I'm going to buy in the secondary market. I don't want to deal with the application process and all that. No, that's not me. I'm the guy that's going to buy a bunch of loans in the secondary market. And I'm going to free up the bank's money so they keep on lending to you. Does that make sense? Any questions? Any questions? Okay. You're probably wondering, why do I need to know about the secondary market, right? All right, so you need to know primary and secondary markets so you understand how things work. Whoever operates in the primary market, if you guys remember, they might charge additional fees. They might charge less fees. It all depends on what they intend to do in the long run. A portfolio lender might charge more money. Why? Because they're going to carry the cost of the loan over the 30 years. A warehouse lender, those that sell to the secondary market, I don't know, they might charge less. That's why the APR is important to know. All this relates one to the other. Question: what happens to a mortgage loan that goes into default if someone doesn't pay it off? There's foreclosure. Right? If you don't pay off on the mortgage loan, there's a foreclosure. If it's in the secondary market, if somebody bought the loan, then that person or entity is the one that's going to foreclose on you. So it's no longer Bank of America that lent to you initially. Now it's Chase that's going to foreclose on you because they purchased the loan over the years. Right? It's like a collection company. You don't pay the original creditor, then here comes a collection company try to collect from you. It's pretty much the same concept. You don't pay, the collection company takes over. All right, so as major players in the secondary market, the Fannie Mae, Freddie Mac, and Ginnie Mae, they tend to set the standards for the primary market. See, Fannie Mae or Federal National Mortgage Association, I call Fannie Mae Grandma. Because Grandma is the oldest on the block and everybody listens to Grandma, right? So Grandma, Fannie Mae, they buy conventional FHA-backed and VA-backed loans. They give bank mortgage-backed securities in exchange for blocks of mortgages. They offer lenders firm loan purchase commitments provided that they conform to Fannie Mae's lending standards. They sell bonds and mortgage-backed securities, and they guarantee payment of interest in principal on mortgage-backed securities. So Fannie Mae, out of all these, is the one that sets the standards. Okay, as you see here, Fannie Mae's lending standards. Even the loan applications are traditionally made in the standard Fannie Mae's forms. It's not a government form, it's Fannie Mae. Fannie Mae is a privately owned company that purchases 1 out of every 10 loans out there. So if you originate 10 loans today, Fannie Mae is buying 1 of them, right? So Fannie Mae has a great power in the lending policies. Whatever Fannie Mae says, banks do, right? So these are called conforming loans versus portfolio loans. The next one we have is Ginnie Mae. Now, Ginnie Mae is the baby, was just created after 2008-2009 recession. And Ginnie Mae was created to guarantee payments on Fannie Mae high-risk, low-yield mortgages, and also absorbs the difference in yield between mortgages and market rates. So Ginnie Mae was created to take the hit of all those bad loans that happened until 2008. Ginnie Mae also guarantees privately generated mortgage securities backed by pool of VA and FHA guaranteed loans. And the next one is Mac Daddy, Freddie Mac. Now, Freddie Mac, which comes from Federal Home Loan Mortgage Corporation, don't ask me why, that's Freddie Mac. They buy mortgages and pulls those mortgages in, so they bundle into one larger bond. So I put 1,000 mortgages together, and I say, hey, you want to buy into this pool of 1,000 mortgages? So I'm selling bonds, right, or guarantees on this money. So what Freddie Mac does is buy these loans and then sells certificates to the performance of those loans. Okay. Are you guys good so far? Give me a thumbs up if you're good. Yeah? Okay, great. All right, here's what we're going to do. Before I get into this section, because now it breaks into 2 sections, but it will take a while. And we're going to talk about conventional, FHA, and VA guaranteed loans. Before we get into this section, we're going to take advantage of taking a break right now. All right? If you need to go for coffee, if you need to go for water, if you need to go to the bathroom, do all now. We're going to be back in 10 minutes. It's 11:39, so 11:50. We'll be back. So you got 11 minutes. All right, guys, I'll see you in a bit.